I have a huge problem today, Fred. Can you sing? Are you a good singer?
No, not at all.
No?
No.
Me either. So, but today is the 6th anniversary of the fund.
Okay.
Actually, so it's actually we should celebrate a little bit, right? So,
yeah.
Thanks.
Congratulations.
Thanks. So I wanted to today talk about our global AI fund. We tried to develop kind of like the digital Warren Buffett, so to say. Acatis is a value investing asset manager, and yeah, as said, we try to incorporate the philosophy that we have in our company to the AI. So a few topics that I have with me. So first of all, of course, some slides about ChatGPT and the likes. For us, I think it's kind of like the genie is out of the bottle moment, because, of course, everyone can Google, and the accessibility to people that are not techies is huge, and that's why we see this huge increase of the number of users of these generative AIs, and I think we should take a moment to look at these results. And then, of course, I would like to share what we do in our fund, some main facts, the investment process, and of course, the most recent results. Because the 6 years were not always times where things went up. We also had some times where things didn't play out like we expected it. So I think that's something very good to share with you as investors. So first of all, we saw these models like Midjourney or DALL-E that can create these great pictures, of course, which is yeah, outstanding, if you will. But of course, on the other side, we also see stuff like yeah, Trump being arrested, which was a fake picture, even so many people would have said, why not? And of course, we also saw, like, I don't know, the Pope in an interesting jacket, or the Queen at the turntables, or also our huge idol Warren Buffett as a slumdog millionaire. So for us in the future, it will be very interesting to see how we distinguish between reality and fiction. Also, if we add on top of these picture generation, also, yeah, that you really have videos on top of that. So how we deal with that. And of course, when we talk about asset management, we had it at the beginning. So these models are purpose-built. And if we use ChatGPT, for example, to look at such a very basic question of, for example, how much did Applied Materials spend on R&D, then ChatGPT might be not the best place to go to, because it's sometimes hallucination what you get as a result. And we also see that if we look at what it gives us. So you see the first 3 tries of ChatGPT, and the numbers are slightly different every time. And if you look them up in the 10Ks, you get at least, I mean, the direction is maybe correct, but the numbers itself are not correct. So of course we need some more models that are purpose-built for these specific questions. And ChatGPT, we had it in the short break. Maybe it's good to write a birthday card, for example, or something like that, right? So something creative. But for these kinds of questions, we need different tools. So yeah, no fiction, just reality. The fund is now 6 years old, and we have some basic ideas that we try to incorporate in the fund. So the first thing is we try to give the machine the chance to analyze companies like our human portfolio managers do. So the stock selection is done by artificial intelligence. We are not fast, so we just rebalance every 6 months. The machine just has the chance every 6 months to kind of like reanalyze the companies in the portfolio. And the task is very specific. I will come to that in a second. At the beginning, when we launched the fund, we did it in a different way, but we come to that. But now it's the task to find the best companies in all the different industries by looking at company-specific data. So everything you find in annual and quarterly reports, everything that you can read about when they do their quarterly earnings calls or half-year earnings calls with analysts. And we don't incorporate macro data, so there's nothing like interest rates or something like that, because we want to specifically, or we want to let the machine specifically see what kind of impact, for example, if interest rates raise, have on their business. Because if there is a company that has no debt or it has a lot of debt, that makes a huge difference if there is an increase in interest rates. The second thing is we do a very plain vanilla portfolio construction. In the end, we try to be as neutral as we can be to our benchmark, which is the MSCI World Index, on a sector and region level. So what does that mean? So if the MSCI World is invested, for example, 25% in the IT sector, we try to be more or less in the same range in the fund. We don't want to let the machine bet highly on one single name, but more like to have a really broad result in the end. So closely, equally weighted, the companies that we invest in. And we don't let the machine take any cash decision. So there's no timing component in there. Which, of course, on the other side of means that if there's a crash like we saw in Corona, then the fund is also going down like the benchmark does. So, but you get 100% equity if you buy this equity fund. I think the most interesting thing is we actually had 2 phases in the history of the fund. Or let's say 3 phases. The first one was of course, like first of all, researching the topic. How can we use artificial intelligence in the investment process? Then we launched the fund in 2017 with, of course, specific expectations, what we wanted to see from the AI. And the result in the first 2 years were not like we expected them. So we had 0 return. We didn't lose any money, but we tried to outperform the market. That was actually the task for the AI in the end. And it didn't manage to do so. So after 2 years, for us, it was quite a good time to sit together and take a look at where did the AI did a good job, where did it a bad job, where we maybe give it too much data, or we haven't defined the task for the AI, not specifically enough, so that it can do a good job. And so we sat together, analyzed this, and we used a different kind of model. We did this plain vanilla portfolio construction. We can talk later if you're interested in why we have done that more specifically. Today is I think not enough time to tackle all these things. But since we relaunched, in a way, our strategy in the summer of 2019, we did actually get the results that we expected. So we have roughly 3% outperformance per year. If you sum that up, you're currently at 14% outperformance in this period since we relaunched the fund with this specific investment process. And I think what is also very important in our fund is that we really give investors a diversification effect. Because if you look at a lot of asset managers, they kind of like invest in the, I don't know, top 20 names of the MSCI World. So you see these Googles and Microsofts and whatever. And if you measure the active share of a fund, so if you have an active share of 0, you're actually hugging the index. And if you have an active share of 100, you're as active as you can be from the stock selection side. Our AI is actually a very active portfolio manager, so to say, because it invests in more like smaller names, value titles, and we will see that. We will see that later. We don't do that solely by ourselves, so we have our own AI capabilities in-house where we develop models. But when we launched this fund, we actually had already a longer cooperation with a company called Nascence, They are actually building models in very different industries, so not specifically on finance, but we cooperate since 2015 with them for the topic of long-term value investing, so to say, combining that with artificial intelligence. And yeah, Professor Jürgen Schmidhuber is one of the pioneers who might be known to you, and he's one of the co-founders of this company. So just as a brief overview, so value philosophy in our house, what does that mean? We have on the left-hand side the data sources, company-specific data, annual reports, quarterly reports, and we have these earnings calls and stuff like that on the text side. Then there's a human being usually in the middle that is kind of like analyzing all these data, bringing in some experience, and on the right-hand side you get some kind of value portfolio. The only thing that we do in the fund actually is to not have the human being in the middle part, but to have an artificial intelligence model there. And in the end, if you look at the names, there are a couple of ones that have also these value characteristics in the end. So how do we do that if we look at the investment process? So first of all, we are just working, or we just let the machine work in developed countries, like the MSCI does. And we kind of like filter it to companies with a market capitalization above 1 billion euros. So we have 9 sectors that we invest in. 2 are excluded, which was one of the changes we have done in the summer of 2019. So financials are excluded, and the real estate sector is excluded because, for example, for banks, if you looked at debt, that's their business model. For other companies, debt is a burden, maybe, if it's too much. So from a definition point of view, it's sometimes a little bit hard for the AI to distinguish these different definitions in different sectors, so to say. And we saw in the first 2 years that it hasn't done a good job in these sectors, so we excluded them for the time being. Then I said the 23 countries developed world. And what we feed in for as an input is a set company-specific information for some company XYZ. Currently, there are 57 different time series that we show to the machine. And now we take a look how the stock selection of the model actually works, because it's not like we're doing it like a human being would do it, like looking at one company, analyzing it, and then going to the next company. Because if we do it like that, then it's not a big data business, so to say, if you do it like that. Instead, we do it in a different way. So again, we have the sectors, and let's say just for the moment, we look at the IT sector a little bit more specific, and let's say it's just an example, of course. Let's say we just have these 5 companies: ASML, Microsoft, Nvidia, Intel, and Apple is the whole IT sector for the time being. What we ask the machine now is to compare for some future time period, for some month, in which company would you like to invest? And we do that by pairwise comparisons. So we do all these comparisons, okay? We show for every company, we have some kind of scorecard, so to say, these 57 features, these 57 time series per company. And the AI always has to decide in which company it wants to invest over the time period. And when we finish that process, of course, what we can do by hand is we can just simply count how often the AI said, okay, I want to invest in Apple, or how often I want to invest in Intel, or whatever. And you get some kind of top flop list for the sector. So this is what's happening. Of course, in the learning part, you would always go back to the machine and would say, after, let's say, 12 months, if it has done a good job or not. If not, it needs to adapt its investment style in a way to be successful. But when we are rebalancing, this is kind of like what is happening. On the portfolio construction side, that's now the last step of the investment process. Again, this is just exemplary, so it's not real data, what you see here. We have these different sectors, and in every sector, of course, we get like the top names by the artificial intelligence model. And the first thing is, what we do is we exclude some that are not sustainable by our sustainability department, which is defined by them, which is not a big deal for us to exclude them, of course. And then we have a second ingredient to the portfolio construction, if you want, which is the sector weights and, of course, also the regional weights of the MSCI World. And yeah, it's actually pretty easy. We combine these two ingredients, so to say, and yeah, have a at least more or less neutral sector and region portfolio to our benchmark. The thing is, why do we do that actually? Because in the end, if we have the result, outperformance or underperformance of the fund, we can directly say it's because of the ability of the AI model to find the best companies in the sector or not. So pretty easy to kind of like debug if there's good results or bad results. Yeah, and as said, since we have relaunched the strategy, you see in blue, that's the development of the fund, in red of the MSCI World. If we look at Morningstar, we are usually compared to the MSCI World Small Cap, which is the gray line, which is even more outperformance against that benchmark. But as you can see, in the last 1.5 years, it was actually a headwind to invest in smaller companies. But still, the machine was able with that investment style to outperform, and that's also why we have a 4 to 5 star rating at Morningstar. And yeah, that's what I have said already. So if you do a portfolio performance attribution of the results, so you would like to explain where the outperformance is coming from. Is it coming from the allocation, because you overweight IT companies or the IT sector, or did you overweight your US weight? Or is it because you selected the right companies? You see on the right-hand side, the AI stock selection is the reason why the fund has outperformed. So we can clearly say that the AI did what it is supposed to do. And we also tackled this already. So what you see here in the spider chart is kind of like the factor exposure of the portfolio. And you see the AI likes to invest in smaller companies, which are high profitable, higher quality, a little bit of a value tilt, which is maybe not so surprising if you look at the input data that we feed to the machine. So that's the investment style. And yeah, as said, when we look at I think every one of us saw some kind of charts where you see something like the top 5 names in the S&P 500 contributed for, I don't know, 98% of the performance or whatever. Still, the fund achieved a performance on par, slightly outperforming this year, even though it is not investing in these names. So if you look at the biggest name in the fund, which is Danone currently, is on place, I don't know, 300 in the MSCI index if you sort it by the market capitalization. So great results. Oops, sorry. So this is how the portfolio looks like. For us, always very interesting, because if we sit together with our human portfolio managers, they know maybe half of the names. So for them, also rebalancing is kind of like new ideas, new idea generation. And I can tell you, it was not all the time in the history that it was like that. At the beginning, when we launched the fund, they were more like laughing behind their hand when we started a new portfolio, and they didn't know the names and stuff like that. But since the fund and the AI did a good job, they are listening to it. And even though also the fund is still very small, we had that at the beginning of the conference. So the fund currently has a little bit more than 20 million assets under management, so still very small. I think if we have another 4 years of this performance and the AI is doing a good job, I think people will invest in it. Why not? I mean, I'm also driving a car, even though I don't understand all the technical details of the car, right? So if it works, people will invest, I think. And as said, the active share is, I think, something very, very interesting for investors to have a real diversification effect if they invest in equity funds. So just maybe some names which look at first glance a little bit awkward. So WWE is a wrestling company, so they do wrestling events. And if you look at the current event, the WrestleMania 39, with 162,000 fans in 2 days, I mean, that's I don't know. I mean, it's not something where I would go to because I don't see nothing there in the middle. You see this small white space where they do the stuff, the wrestling stuff. But people like it, right? So and if you look at more like the fundamental numbers, so number of events and the average ticket price that the company they have a pricing power in the end, which you see here. So the light blue bar at the right hand side, they were always able to increase the average ticket price. So also for us as value investors, we're always talking about mode and stuff like that, and pricing power, of course, is something which is some kind of indication for a mode. And they are slightly getting back to the number of events that they had before the Corona crisis. And of course, this was not overlooked. And in April, we had the news that the company is going together, like in a new company with the Endeavor Group Holdings, and that's also something that is very interesting in the history of the fund, because we saw that the machine has detected from time to time candidates and attractive takeover candidates. So not the first time in fund history that we saw that event. And then because that's also something that we had. I think today, if ChatGPT is able to give us some kind of like reporting or stuff like that, so I did it for another company, the Ensign Group. It's a company that does first-class care and assisted living in the US. And if you do a Porter analysis and you read, you don't have to read it all, but it doesn't sound like too far away from what I get from some of the brokers out there. So I think as a basis for additional work, I think that's for everyone a good start, and we should use it also in this case. So also there we see great fundamental developments for a number of facilities that they manage, and also the quality of the facilities is getting better and better. Yeah, kind of like to summarize, why should somebody invest in this fund? First of all, of course, the unique selling point is that we use artificial intelligence to analyze the companies, and this shouldn't be the only reason to invest in it. The reason should be it works, so it outperforms with a small cap value style. In the end, and you have a real diversification effect. Also, we are kind of like in a niche because we just use the fundamental company data and the earnings calls to analyze companies. We also heard like from satellite data to whatever today. So nothing that we kind of like use for our approach. We always want to have company-specific data that is also has a broad coverage for all companies worldwide in the end. So satellite data is not among it. And we have a plain vanilla portfolio construction, which is easy to understand for everyone. I think that we kind of like mimic the sector and regional weights of our benchmark, the MSCI World, with the 50 best ideas of the artificial intelligence model. and yeah, some fun facts, contacts, and of course everything can be wrong what I've said. So yeah, happy to take questions if there are.
Well, Kevin, that is a wonderful testimonial to AI investing. I'm not promoting anything, but you've delivered what you promised, the value to an investor's portfolio, outperformance, and diversification. With regards to the fundamental data, do you use a lot of the data from Acatis? I mean, I don't remember how old Acatis is, but they must have drawers and drawers and drawers of data, you know, because you're value investors, and this is just AI value. So, is a lot of the data, historical data, come from in-house?
I mean, of course, it's bought by data providers.
Yeah.
So the fundamental data, of course, yeah. I mean, Acatis is now, I think, 25, 30 years old. So we have some, let's say, specific numbers that we calculate that also the human portfolio managers use for their daily work, which are also included kind of like as a time series to analyze these companies. So, of course, there's also experience from the human management side that we can include in the fund. Yeah.
Okay.
So you mentioned that you rebalance the portfolio every 6 months, which I guess is because of semi-annual results in the balance sheets, right? So how much of a timing issue do you have? Like, because not all companies report at the same day. That would be great, but it's over a period of 2-3 months. And I guess when you're too late, you miss the gains because some companies reported better or have better development than anticipated. So how do you handle that? How do you get like a good balance of not being too early and just having 50% of the data and not too late before everything is priced in?
Yeah, yeah. Yeah, good question. So, of course, if you just do US, so we will hear later from Eric about that. So there we do quarterly rebalancing because we can be pretty sure that everyone is doing quarterly announcements. If you do it globally, yeah, as you said, there are countries where there's just semi-annual numbers that you can get, and from the timing perspective, well, we try to be. That's why we do this portfolio construction part very neutral, so that we don't have any timing stuff in there. Of course, we don't get the result maybe directly after the announcement of the numbers, but that's also not our game. So we don't want to be like in this fast decision game, so to say, but more like to have steady and predictable fundamental performances of the numbers. And if you do long-term investing and you hold the companies for longer than a couple of days or weeks, I think it's the timing is in a way not that important. Of course, some may for some companies you're late, but for some companies you maybe get a good entry. So I don't think that we need to time. So we actually don't do it. Yeah.
Perfect. Makes sense. Thanks.
I also have a question.
Yeah.
So you do the pairwise comparison of the scorecards of the stocks. Mm-hmm. Do you also, and then do a ranking, do you also have a feedback loop after realizing the correct ranking to retrain the metric?
Not the ranking itself, but on this like we do this pairwise comparison. And of course, when we are in the learning phase of the model, so when it doesn't know nothing, mm-hmm. Of course it does have to do the same task. And let's say I don't know, Apple versus Intel, and it decides to invest for the next 12 months in Apple. Then exactly what you said, we look after 12 months if it was the right decision to do so, and then we give it a feedback. Mm-hmm. Okay, great, you did a good job, or you did a bad job. And in this case, it needs to adapt its strategy slightly. So focus more on, I don't know, sales growth for the time being, or focus more on the earnings yield, or how much debt the companies have in this specific sector. So it's always adapting. Every half month, we do this process of retraining the model when we rebalance, so that it can adapt to the current market situation in a little bit in a way.
Okay, great. Thank you. Yeah? Yes, yeah. Yes. Thank you.
You didn't mention anything about the environmental issues. You said you don't invest in financials and real estate.
Yeah.
Is it okay just to invest in polluters as long as they?
Well, that would be a question for our sustainability department, actually.
Yeah.
Yeah. As said, I mean the fund is categorized as Article 8. So we have an Article 8 strategy for the whole company of Acatis, okay, which we apply there. But we apply it not at the stage where the machine learns, because the machine, of course, should learn that there are oil companies out there, right? So it's not like they are not there. So it learns also with the oil companies, but then in this portfolio construction step, we exclude the ones that are, for example, like BP or Total or whatever. So we exclude these kinds of companies. Okay. Yeah.
Wonderful. Kevin, thank you very much.
Thank you too.